supervisor. What is the difference between financial accounting and managerial accounting? Anybody?
Financial accounting is more for external sources like investors, creditors, and stuff, and accounting is more for internal use.
Good.
Managers.
Yes. So managerial accounting, management accounting, that's in chapter 16. It's for internal users. The financial accounting that we've been doing majority of the class so far, that is exactly right. Investors, it's your outside users. It could be an investor, it could be a bank, because sometimes banks require you to get financials to get a loan. So those are two examples for financial accounting users. Okay, management accounting. Yes, some highlights on this slide. This second point does not have to conform with tax or GAAP. So if you remember, financial accounting, you had to conform to GAAP. And here are three main principles. Management accounting systems help decide who has decision-making authority over company assets. Accounting information produced by or created from a management accounting system supports planning and decision-making. That goes along with your comment about forecast. So I love that word about forecast. Number 3, management accounting reports provide a means by which to monitor, evaluate, and reward performance. Okay. So this next slide is kind of expanding on this first principle of decision making. So decision making authority. Let's see. Yeah, I mean, this is just kind of defining like the authority. Typically in a business, different managers or even employees, they're assigned to certain assets. And hopefully, this is for bigger companies, right? So the smaller companies, there's people wearing multiple hats. They're in charge of all the assets they have. But job description, verbal instruction, from supervisors, internal accounting document reports, those all are different managerial type reports that would come into play with, or even communications, whether it's report or just communication with people in your organization that talk about their role and responsibility and their decision-making authority. So managers need information. They need it to be, so when a manager looks at a report, they need it to have confidence that it's reliable, and timely information helps them make timely decisions. So they're making decisions based on historical information and projected information. And here's a little visualization of some framework. You have top management, budget plan for the future. So you see, this is supposed to talk about, the process that a management goes through each year. You're planning. You probably heard terms budget, so you go through a budget season for your business. Then you're in business, you're reporting actual results, and then you are analyzing your performance based on what you planned or forecasted to have for that year. Another term for budget or forecast that some businesses use is outlook. So what's the outlook going to be for the future months? This is a slide that this first column, financial accounting, and the second is management accounting. So you can see the different uses for this expands even more on your answer of what financial accounting and management accounting. And it has different ways to even look at it. The purpose, types of reports, standards, reporting entity, time periods, users. I think we talked about purposes, types of reports, financial accounting, your income statement, balance sheet, cash flow, and then the type of management accounting. I mean, you can come up with whatever report you want that is giving a stat or some information to help you manage your business or make informed decisions to operate a successful business. I mean, those, for the most part is, think of operations for your business. So take the oil and gas industry, like more of a upstream oil and gas company that's they're they have the oil pumps in the ground, where you guys have those up here, right? You know what I'm talking about, like a pump jack where it's going up and down, pumps the oil and gas out of the ground. You know what I'm talking about? And so there's measurements on that oil and gas, and so um, there'll be a foreman in charge of 100 different wells for that company. And that foreman has goals of, okay, this well is supposed to be producing 10 barrels per day, and so you'll have reports on daily reports or weekly reports of whether for each well, whether they produced what was forecasted in production. So you could have all sorts of managerial reports on production reports to analyze the production that came from each well. So you have a report that had every single well on it, or it could be grouped into different sections that made sense for that business. It could be different regions, so you might be a manager for, take the oil and gas example, you might be a manager for 3 different states that you have oil and gas wells. And so you have the data, production data, and expenses that it took to operate those oil and gas wells, and you have useful reports that would help that regional manager make decisions on how to make those wells the most profitable, or if there needs to be work done to increase production, or whatever else needs to be done. So yeah, you could see, like, it depends on your industry, depends on what business you're in, and what's useful information for you to have for all the different various non-standard reports that you can generate. The time period is one thing to note. Typically, financial accounting is a year, quarter, or a month. Management accounting, it's whatever you need to look at, any period. We talked about the users already. Principles of management accounting: assigning decision-making authority, making and supporting decisions, evaluating and rewarding performance. I think we talked about that too. Okay, manufacturing companies. We've kind of talked about this a little bit already with our discussion on gross profit, cost of goods sold, inventory. So anytime you see the word manufacturing, that's talking about a company that manufactures inventory that they sell. And so with those type of companies, you're going to have cost of goods sold. And so this slide is telling you what typically makes up cost of goods sold for a manufacturing company. Manufacturing cost is what this is called. Direct materials, direct labor, manufacturing overhead. Those are the main components. Yeah, so that the overhead, that's not to be mistaken with um, overhead that's allocated to like an office that's totally dedicated to your general administrative staff. So for example, um, if you have, we'll take the oil and gas example. If most of the time, oil and gas company, they'll have like a headquarter. Most industries have like a headquarter corporate office, and then they have field offices where they're either manufacturing, well, in this case, manufacturing product. So the oil and gas might not be, uh, it might be harder to understand. Probably, you know, I know this guy that manufactures plastic materials and like all sorts of plastic, Tupperware, storage, all sorts of things made out of plastic. He has different offices all through the U.S., regional offices where they manufacture. There's a couple of different manufacturing facilities, but then they have a corporate office. The people that work at that the corporate office and the overhead you have for utility, maintenance, taxes at the corporate office, that's not included in your manufacturing overhead. It's only the actual building and facilities and assets that's used to manufacture that inventory.
So if that's all in the same spot, your headquarters is where you manufacture.
It's a good point. Yeah, good question. Yeah, so then you would need to have a percentage that you allocate. So if it's at the same spot, you allocate. Well, if it's most of the time it's off square footage of that facility. That's one easy way. There are some companies that go even more detailed because if you think of it, sometimes you might even have a lower amount of square footage, but the amount of power they're using for that area they're manufacturing, they're using a whole lot more utility, electricity, gas. There's a lot more maintenance involved. So yeah, it might not be as easy as just an allocation of square footage. Um, so yeah, you can see how detailed that report can get depending on how you're allocating. So another key term with managerial accounting is allocations. There's allocations going everywhere. It depends on, in this case, you're allocating overhead depending upon the amount of usage for that building. Yeah, this is just to reiterate anything that's not related to manufacturing the goods or cost of goods sold, it does not appear in cost of goods sold. It's not used in that calculation for gross profit. Might be selling expenses, salaries at the corporate office, overhead at corporate office, advertising expense, those other expense line items that don't roll up into cost of goods sold. This is just some more information on the different manufacturing costs with direct materials, direct labor, manufacturing overhead, and you can study that later. That's it for these slides. I am going to give you a couple other tips for the quiz that maybe the slides did not get covered. Yeah, there might be, you might need to study solvency, um, the, the current ratio, quick ratio, working capital. But one clarifying thing that might not just pop out in your textbook or the slides is uh, when you think of the solvency, you're thinking it's balance sheet ratio. So you're getting these numbers off balance sheet. Okay, I'm going to give some true and false. Um, let's go through some true and false questions on what a quick asset is. True or false, a prepaid expense is a quick asset. False. Correct. True or false, automobiles are a quick asset. False. True or false, inventory is a quick asset. False. True or false, accounts receivable is a quick asset. True. All right. Okay, here's some more true and false questions, and it is okay. So managerial accounting. So true or false? Managerial accounting is less likely to be tailored to specific needs of an individual decision maker. Correct. False. True or false? Managerial accounting is less likely to make use of estimated amounts. That one's false. We didn't talk much about that, but yeah, managerial accounting, you have a lot of estimates and forecasts and planning involved in those reports. Okay, true or false? A managerial accounting report is less likely to focus upon future accounting periods. False. Yeah, that's more financial accounting. True or false? Managerial accounting is less likely to focus upon the entire organization as the accounting entity. That's true.
Because it's less likely.
Because I said less likely.
On the entire.
So is it like less likely compared to internal?
Yeah.
Okay. Okay.
Yeah, good clarifying comment. It's less likely compared to financial accounting. That's how we're viewing that statement. Okay, that's it.